To Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Join us at the market site in Times Square. We have Chris Englebert. He's the founding partner and chief investment officer over at Englebert Financial Advisors. We're going to take a look at some RIA strategy in helping clients manage headline risk. Chris, great to have you back with us as always. Englebert Financial Advisors looks like someone went independent.
Yes, absolutely. Very excited about it. It was time to spin off, form our own firm. We find that our team has a real niche market. We do a lot of institutional business, high net worth business, but really more than anything else, we tend to use social media a lot to communicate, and we really think that by branding ourselves as Englebert Financial Advisors really helps to get the message out there to clients and obviously other investors as well.
All right, let's talk about what clients should do about headline risk, which is very relevant in today's market.
Yeah, it sure is, Jill. I mean, dominated, whether you're on Twitter or somebody's tweeting all the time and the market's moving up and down several hundred points or 1% or 2%, we're asking that what clients should really do is they should call their advisor and talk to us about how is this news affecting my market. So for example, in the portfolios that we run, we're underweight emerging markets right now. There's been a lot of news about China, a lot of volatility about China, but if you're not there, you're not really affected. So we really want that dialogue with our clients like, hey, this doesn't really mean that much to you because you're really not in that particular area.
All right, let's move along to our next slide. Helping your clients when the news dominates the market. So I can imagine yesterday, what was it, Tuesday, September 3rd, you must have got a lot of calls. Oh my gosh, the market's in correction territory. I'm sure that was going through their minds. Now today, Wednesday, September 4th, it's a very, very different picture. The Nasdaq Composite up over 1% as we speak. Got to be some hand holding there.
Yeah, absolutely. And it's like, the old adage in real estate, location, location, location. The same adage when you're talking to clients, you got to communicate, communicate, communicate. So what we try to do is we try to bring out videos. We try to obviously use Twitter, LinkedIn, et cetera, to get our message across. So for example, I have an app that clients can download on their phone. And I just did a video on Tuesday talking about what our view is for the rest of the year and how we think things are going to trend. A lot of this stuff is noise, but yet it's so 24/7 nowadays that clients get bombarded with this. And I really think that a lot of advisors are doing themselves and their clients a disservice by taking a very passive approach, waiting for people to call them or reach out to them. If you're really providing value as an advisor, you should be pushing out content. You should be talking to your clients about, here's what we expect in the global markets. Right now, and we'll get into the charts in a minute, there's that narrative that we're in a recession. Our view is different. You need to communicate those views with your clients.
I think the app's really interesting. I saw on the website, I believe you just text a code.
Yeah.
And then the app is available.
Yeah, I have.
Your advisor
absolutely.
Instantaneously.
Yeah, absolutely. Somebody texts Chrissy to 36260. They can download my app. Our content's on there. And in fact, what we just started doing was in every email, I embed a video. Hey, here's our September update. Here's what we think is going on.
Oh, it'd be great. Wake up and see your face every day. Let's take a look at those charts. We haven't caught up on this in a while. Our first one being the S&P 500, and a lot of people I'm talking to, they expect this range-bound activity to continue.
Yeah, we do too. Right now, obviously, the headline news is dominating what the markets are doing. But if you look at where we came from and where we are at, I mean, we had a nice correction the end of May, beginning of June. We rallied to new highs. We really think that we're starting to build up some kind of base, and we are much more positive in the latter half of the year. We think this range-bound activity could last through the month of September until you get more clarification as far as what's happening with trade, what's happening with earnings, and also what's happening with interest rates too.
All right, our next chart, the Nasdaq 100. Now, these are the top 100 technology and other stocks in the Nasdaq Composite X Financials. So you're kind of seeing where the performance is in the market with the tech sector up nearly 28%.
Yeah, and we think this has been the dominant leadership the last couple of years. It's actually holding up rather well. Some people say that this might be long in the tooth. We don't really think that way. And you can see again, range bound. We had a real nice move. We pulled back. We're range bound right now. Really, it's a consolidation pattern is what we think is going on at this point. So.
All right, now if we look at the Russell 2000, this is a very, very different story than what we've seen with the NDX.
Right. Yeah, absolutely. And so what's happening here is that this is a large cap, large institutional company driven market. The small mid caps haven't really participated. You can see by the chart here, we are in danger of breaking down through that end of May, June low. Is that a negative? I don't know, because it seems that people are beginning to realize that there's a lot of bifurcation going on in the market. There is a lot of value in many of these smaller companies, but they just haven't participated. And we think what may end up happening is they may get to a point where they're so attractive that they're going to offer value into 2020, much more so than they are right now.
I mean, could you imagine if we actually did get participation from the Russell 2000 stocks?
Yeah, stand back. You could quick have a 15 to 20% rip your face off rally.
All right, the 10-year note. Let's talk about this yield.
Yes, this is a weekly chart for the 10-year going back to 2016. Anybody that's watching this Twitter, I am begging you, if you have not refinanced your mortgage, you need to run and do it now. We think that there's a lot of extraneous factors that are driving the 10-year down. You can see what happened the last time 10-year reached this level. We started to see yields back up. Again, the narrative that everybody's heard all summer long is that, hey, we might be going into a recession, and that recession is driving down the 10-year. We think there's a much different take on it. When you have such a large amount of global debt that's in negative interest rate territory, anybody around the globe looking for any kind of yield, even 1.5% looks attractive. I'm much more concerned about interest rates right now than I am about the U.S. stock market, because you can see what happens when rates back up. They could back up rather quickly. There's been a huge positive rate of return in the long duration end of the curve. People have made a lot of money this year, but again, you got to take some of those profits off the table.
But do you think because we are in such a low yield situation when it comes to debt and bonds, what are considered safer haven assets, that kind of lends to putting your money in U.S. equities?
Yeah, absolutely. And that was one of the news stories the last 2 weeks, is now the dividend yield on the S&P 500 is higher than the 10-year Treasury. So again, from a value standpoint, where are you getting more value? And again, we think U.S. equities are more attractive at this point.
Well, no wonder REITs and utilities are performing very well over the past couple months. Let's wrap it up with our chart on crude, finally getting a little bit of a bid there.
Yeah, today we're having a really good day in crude oil. Again, you can see we had a real nice rally through the end of May. We pulled back, again, a sideways trading pattern for this. The crude is really, the headlines are dominating the crude oil market. People are worried again, hey, are we going to have a global recession, not have a global recession? We think that it's a base building pattern. We still believe that there's not enough supply versus the demand, and you could walk in one day when people realize that the U.S. economy and global economies aren't really doing that bad. We projected somewhere in the low 70s as far as crude prices in the next 3 to 6 months. It could happen rather quickly and catch people off guard. But to tell you why we're very positive on the U.S. equity markets, this chart's one of them. We think you have low interest rates, you have low tax rates, and you have low energy prices, and that's allowing the consumer to go out there and reload and be able to spend. 2 weeks ago, Walmart had really good earnings, and everybody was concerned about how lower-end consumers doing. You can see that's why we're much more positive on U.S. equities the back half of the year.
I mean, the consumer really has been driving the positive headlines in this
yes,
for sure.
Yes.
All right, Chris, as always, thanks so much for catching up with
you.
us at MarketSite. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.